Beyond Meat is currently trading at $1.02, down a staggering 5.55% today. Let's be perfectly clear about what this price means. We are not analyzing a growth stock. We are not discussing a temporary dip or a buying opportunity. We are, in real time, watching a company fight for its very survival on the NASDAQ. At $1.02, the conversation is no longer about profitability, market expansion, or disrupting the food industry. The only question the market is asking is about solvency. This isn't just a bad day or a bad quarter, it is the brutal, agonizing culmination of a complete collapse in investor confidence, a story of expectation versus a devastating reality. The expectation, not so long ago, was that Beyond Meat was the future. This was the company that was going to change the way the world eats. The IPO was electric. Investors, from massive hedge funds to individual traders using the Robinhood app, piled in. The narrative was that this wasn't a food company. It was a tech company that made food. It was positioned as the next Tesla stock, but for the grocery aisle. The belief was that it had an insurmountable first-mover advantage and that its partnerships with global fast food chains would guarantee exponential growth. The expectation was total disruption. The reality, as evidenced by a $1.02 stock price, is that Beyond Meat may have just been a fad. Or, at best, it's a niche premium product trapped in a low-margin, high-competition commodity business during a period of high inflation. The expectation was a disruptive new category. The reality is a company facing catastrophic cash burn, declining revenues, and a consumer base that has simply walked away. Let's look at the recent movement and the pressures that have brought this stock to its knees. Today's 5.5% drop isn't an isolated event. This stock has been bleeding out for more than 2 years. The volume we're seeing today, while significant, isn't the panic-selling volume you'd see from a sudden, unexpected crisis. It's worse. It is the slow, steady, agonizing drip of capitulation. It is the last of the retail investors, perhaps those who got into online investing during the 2021 frenzy, finally logging into their SoFi Invest or Fidelity accounts and hitting the sell button to harvest the tax loss. This isn't the high-frequency volatility you see in NVIDIA stock on an earnings day. This is the sound of a stock being abandoned. The macroeconomic environment has been an absolute anvil. When consumers are squeezed by inflation, they don't trade up to premium, expensive alternatives, they trade down. When a package of ground beef is cheaper than the plant-based alternative, the choice for the average household is simple. This isn't a complex investment thesis, it's basic kitchen table economics. The premium brand perception that was once Beyond's greatest asset has become its single greatest liability. This leads to a complete collapse in pricing power. Beyond is trapped. On one side, grocery chains like Kroger and Albertsons are squeezing them for lower prices to remain competitive with their own private label store brand alternatives. On the other side, the company's input costs for pea protein and manufacturing remain high. This is a classic textbook margin compression nightmare, and the company has no way out. The recent earnings reports have been a catalog of disasters. We are not just talking about missing estimates. We are seeing profound double-digit year-over-year revenue declines. In a market that was supposed to be growing exponentially, Beyond Meat is shrinking, and shrinking fast. This isn't a temporary setback. It's a fundamental rejection of the product by the mass market. The novelty is worn off, and the data clearly shows that repeat customer rates are alarmingly low. They tried it, and the majority did not come back. You cannot support a growth stock valuation, let alone any valuation, when your top line is moving aggressively in reverse. This makes any online investment decision incredibly simple. Stay away. I have to ask, and I want you to be honest. Comment below. How many shares of Beyond Meat are you still holding, and what was your cost basis? I am genuinely curious to understand the thesis of anyone still in this trade. For those who are new to this catastrophic story, Beyond Meat's core business was built on creating plant-based meat substitutes. Their flagship products were the Beyond Burger and Beyond Sausage, engineered from pea protein and other ingredients to mimic the taste, texture, and cooking experience of traditional meat. The entire narrative, the one that sold the IPO and got the stock to over $230 a share, was based on a two-pronged growth story. First, capture the retail grocery aisle. Second, and more importantly, use massive B2B partnerships with quick-service restaurants to achieve global scale. This was the reality that was supposed to justify the sky-high expectation. They had highly publicized tests and rollouts with McDonald's for the McPlant, with Yum Brands for KFC and Pizza Hut, and with Starbucks. It looked like a done deal. This was the proof that investment help sites pointed to as the reason for its inevitable success. But the reality of that B2B pipeline was a complete and total failure. The McPlant, after a limited test in the U.S., was quietly shelved. Reports indicated it wasn't just low consumer demand, it was also an operational headache for the restaurants, cooked on the same surfaces as beef, which alienated the very vegan and vegetarian customers it was supposed to attract. The Dunkin' Beyond Sausage Sandwich, once rolled out to 9,000 stores, was discontinued. The KFC trials faded away. One by one, the catalysts that were supposed to launch the stock into the stratosphere fizzled out. This failure is the central reason for the stock's collapse. The B2B growth engine never started, leaving the company entirely exposed to the brutal, competitive, low-margin grocery aisle. And that grocery space is a war zone. Beyond's competition isn't just its rival Impossible Foods. Its real competition is Tyson, Hormel, and Cargill, the very big meat giants it claimed to be disrupting. And even more lethal is the private label competition. The Kroger Simple Truth or the Whole Foods 365 brand of plant-based burgers sits right next to the Beyond Burger for a fraction of the price. When you are an undifferentiated product in a commodity space, you don't compete on brand, you compete on price. Beyond Meat lost that war before it even began. This isn't Apple stock, which has a deep, impenetrable ecosystem. This isn't NVIDIA stock, which has a multi-decade technological moat in high-performance computing. Beyond Meat's moat, it turns out, was a marketing budget, and that budget is gone. This brings us to the most terrifying part of the analysis: the balance sheet. They are hemorrhaging cash. Their quarterly cash burn is astronomical. They are spending massively on R&D and marketing just to tread water, all while revenues are falling. This is an inverted business model. It's not sustainable. The $1.02 stock price is the market's way of saying that the company is on a direct path to insolvency. They will need to raise capital, and soon. But how? At $1.02 a share, a secondary equity offering would be catastrophically dilutive to the few remaining shareholders and wouldn't even raise enough to cover their losses for more than a couple of quarters. Taking on more debt is likely impossible. Their recent debt restructuring efforts were seen by the market as a desperate last-ditch effort. This is a financial checkmate. This is why this stock is not something you'd ever find in a professionally managed Schwab Intelligent Portfolios or as part of a long-term Fidelity wealth management strategy. This is pure, unadulterated speculation, a lottery ticket. Think about the different types of investors caught in this. The Robinhood stock trading platform, famous for its fractional shares, allowed millions of new investors to get into self-investing and buy a piece of this story. Many used their Robinhood cash management accounts to buy the dip and buy the dip and buy the dip all the way down from $200. On the other side, you have highly sophisticated traders, perhaps using interactive brokers. They would have looked at the interactive brokers' trading platform's advanced analytics, noted the declining revenue and accelerating cash burn, and would have been shorting this stock for the past 2 years. The interactive brokers' fees would be a small price to pay for the platform's ability to execute a complex short-selling strategy. This is the harsh reality of the market. The divide between the story that retail investors buy on a SoFi app and the data that professional traders analyze on a platform like interactive broker stock trading. The Fidelity mobile app might be showing a 99% loss in a Fidelity brokerage account, a brutal lesson in what happens when a good story isn't a good investment. Even Fidelity ETFs and Fidelity mutual funds focused on ESG or future of the food themes, which would have held BYND, have been dumping it for quarters. Their Fidelity IRAs have been protected by this exit. So, what is the future outlook? What are the possible scenarios? The bear case is the one the market is currently pricing in.